In recent years, a popular solution for 1031 exchanges has been investing in an interest in a Delaware statutory trust, or a DST. DSTs essentially allow investors to pool their capital together and invest into an institutional quality asset, while also exchanging out of the day-to-day management. For traditional DSTs, the exit strategy for most investors is to continue to roll from a DST to another DST to another DST. Every 5, 6, 7 years, when that asset sells, you would execute another 1031 exchange, and that's known in the industry as a swap until you drop. While this has worked for some investors out there, at Origin, we looked at this exit strategy and saw a few challenges with it. Number one, when you use the traditional swap till you drop strategy, you have idiosyncratic or single asset risk. You're essentially rolling from a single asset to a single asset to a single asset for the rest of your life. And that's a lot of eggs to have in one basket. Number two, it's expensive. The DST industry is rife with high fees. And so every time you sell a DST and roll into a new one, there's a front-end load potentially of 10 to 15% that can eat away at your net asset value. And then finally, from an operational perspective, it makes it very difficult. What are the markets going to be like in 5 to 7 years? Where will interest rates be? Is there going to be equity available? Are you going to like the DST that's available? Can you match your cash flow? Can you match your debt? And so it's a lot of risk to put into somebody's portfolio. So we utilize a strategy called a 721 exchange, or an UPREIT, that alleviates all of these problems. The beginning of a 721 exchange is exactly the same. You would sell your property and roll the proceeds into a Delaware statutory trust. In our instance, we invest in high-quality institutional apartment buildings in high-growth markets. So let's just say it's a $100 million apartment building in Dallas, Texas. You would own that building for approximately 2 years. You'd get all the cash flow from it. If it appreciated, you'd take advantage of the appreciation. You would write it off on your taxes through the Schedule E, just like normal. But our exit strategy is different. We have a diversified flagship real estate fund called the IncomePlus Fund. And after 2 years, the IncomePlus Fund would have the right to acquire that DST interest from you. Instead of giving you cash, which would necessitate another 1031 exchange, we would give you operating partnership units in the larger fund. That would be tax deferred under a different section of the tax code, Section 721, or some people call it an UPREIT. So now you go from owning a single asset into a DST into a broadly diversified portfolio. So you can think of it like, instead of owning a single stock, now you own a mutual fund. So we're de-risking our portfolio by adding diversification. The 721 also requires no more swapping. You would just stay in that fund indefinitely. And we believe at Origin that one of the best paths to wealth is to stay invested into risk assets for the very long term without the frictional cost of taxes and fees. So by staying in that investment for longer, just like Charlie Munger says, the first rule of compounding is to never interrupt it unnecessarily. So this will help you build your wealth in a tax-efficient manner and pass it on to your beneficiaries in a very easily divisible security with a fully stepped up cost basis and no burden of management. Real estate can create unique challenges when it comes to estate planning, as it requires active management. Compared to other assets you may have in your portfolio that you pass on to your beneficiaries, a lot of owners of real estate start to wonder, who's going to manage this asset when I'm gone? Will my beneficiaries be able to manage it? Will they fight over it? Do they want to manage it? And many people continue to hold real estate so that they can get that stepped up cost basis. Well, one of the unique solutions to handle this estate planning challenge is a 1031 exchange into a 721 UPREIT. As we explained earlier, now your real estate portfolio is allocated across a diversified portfolio of real estate. It's invested in a security, so it's very easily divisible amongst your beneficiaries. There'd be no arguing or fighting over the interest. If somebody wanted to sell their interest, they could. If somebody wanted to hold their interest, they could. And of course, they would still get that fully stepped up cost basis with no burden of management. Finally, take a look at the IncomePlus Fund. We think there's a lot of benefits for that to be the final destination for this 1031 exchange via 721 UPREIT. IncomePlus Fund focuses 100% on multifamily or apartment investing in high growth markets through the Sun Belt and the West. Multifamily has had the highest risk-adjusted return of any commercial real estate asset class over the last 2 decades. We don't invest in office buildings, we don't invest in shopping centers, we don't invest in industrial distribution warehouses. And the fund is also tactical. It allows us to build, it allows us to buy, it allows us to lend, depending on what's giving us the best return at that particular time. So for the long term, if you're going to be in a fund, we really like the IncomePlus Fund for the fact that it's multifamily and the fact that we have this tactical strategy that allows us to pivot depending on what's happening on different market environments. You can learn a lot more about this in the IncomePlus Fund as well at our website, origininvestments.com, where you can feel free to book a call with me or anyone on my team.